Welcome back to Investing Talk Podcast.
Today we're looking at Voyager Technologies.
As usual, before we start, subscribe, like, and comment to this video to support the show. And if there's a specific company you want us to look into, leave it in the comments below.
So let's get into the analysis. Voyager is a really interesting company sitting at that intersection of defense and space tech.
Right. Mission-critical solutions.
Exactly. And the recent numbers, well, they caused a bit of confusion, so that's probably the best place to start.
Yeah, let's jump right in there, because if you just read the headline, Q3 net sales were what, $39.6 million?
Yeah.
Which looks totally flat year over year.
It does.
And for a company in, defense and commercial space, flat revenue feels, well, it feels wrong. So
Okay.
Why is that number so misleading?
It's a classic case of noise obscuring the signal. The flatness is all because of a planned strategic decision.
Okay.
They're deliberately winding down an old legacy NASA services contract. It's low margin, and it just doesn't fit their high-tech strategy going forward.
So it's a drag on the numbers that they're choosing to get rid of.
Exactly. It's addition by subtraction.
So if we pull that out, what does the real growth picture actually look like?
Well, excluding that specific contract, the core business, the part of the company that's actually their future, grew a really solid 15% year over year.
15%. Now that's a totally different story.
It is. It shifts the whole narrative from, a stagnant contractor to a high-growth tech company.
And if we drill down even further, the real engine behind that growth is the defense and national security segment.
Oh, absolutely. That part of the business was up a robust 31% year over year.
31%. That's a serious number.
It is. And this is where the story gets really strong. That jump means the defense segment brought in somewhere around $28.5 to $29 million just in Q3.
So that now makes up, what, about 3/4 of their total revenue?
Pretty much. And that mix shift towards high-priority defense spending it's a huge structural positive.
Because these aren't discretionary contracts. We're talking about things like missile defense, resilient satellite comms.
Things that are non-negotiable in the current geopolitical environment. They're funded by multi-year budgets with very high switching costs.
Right. So better visibility, probably better margins than the old stuff they're shedding.
Exactly.
Okay. So the current revenue story is healthy once you look under the hood. But, revenue is a lagging indicator. How confident are we that this demand is locked in?
The forward momentum is, I think, the strongest piece of evidence we have. Management reaffirmed their full-year guidance for FY25 between $165 to $170 million.
And they expect to finish toward the high end of that.
That's what they're suggesting, which implies around 18% growth for the full year.
But the backlog, that's the number that really tells you about the future.
And that's where the confidence comes from. The backlog grew 10% just from last quarter, up to about $189 million.
Wow.
And maybe the most telling figure of all, their book-to-bill ratio was 1.25x.
So for anyone listening who isn't familiar with that metric, what does a 1.25x book-to-bill actually mean?
It's a massive green flag. It means for every dollar of revenue they brought in, they booked $1.25 in new contracts.
So demand is growing 25% faster than they can even recognize the revenue.
Yes. It suggests there's real upward pressure on future revenue.
Okay, that robust demand validates the growth story, but we have to talk about the elephant in the room, profitability.
Right.
They are not profitable. The Q3 adjusted EBITDA loss was $17.7 million, and they're guiding for a full-year loss of, $60 to $63 million? That's a lot of cash burn.
It absolutely is. But this leads us directly to the company's foundational pillar, and that's its fortress balance sheet.
Okay, so this is the counter-argument.
It is. For any growth company, especially in a capital-intensive field like aerospace, the balance sheet is everything. It's their shield.
So what does that shield look like in numbers? Because this is where they really seem to stand out.
They're holding about $413 million in cash and cash equivalents. And this is the crucial part. They have zero outstanding debt.
Zero debt.
Zero debt. And if you add their undrawn $200 million credit facility, their total liquidity is over $600 million.
So what does that mean for you, the investor? If they're burning $60 million a year, that cash gives them, 6-7 years of runway?
Easily.
Yeah.
It gives them years to execute their plan without having to panic and raise money in a bad market. It significantly lowers the risk.
It lets them focus on execution.
Precisely. It lets them focus on the big projects, particularly Starlab.
Let's talk about Starlab. That's the real long-term catalyst here, right? Their big bet on commercial space.
It is. It's the competitive moat they're trying to build. The International Space Station is getting old. It's nearing retirement.
And NASA needs a replacement.
NASA and the U.S. government are heavily incentivizing the private sector to develop commercial replacements in low Earth orbit, or LEO. Voyager wants to be one of those successors.
And they've already hit some key benchmarks, which is a good sign.
They have. They've achieved 2 critical NASA milestones for the Starlab program, and they got $4 million in cash for it. It validates their path.
And it's not just the big programs. They're also using M&A to build out their platform.
Right, that's their fast-track strategy. They recently integrated 2 key acquisitions, Electromagnetic Systems and Exoterra Resource.
So what do those bring to the table?
Well, EMSI gives them advanced communications IP, and Exoterra brings propulsion, so they can integrate satellites and then move them around in space.
It sounds like they're trying to build a full in-house technology stack.
That's exactly what it is.
Yeah.
And management expects those acquisitions to start adding to profitability to become accretive sometime in 2026.
Okay, so the fundamentals. The 15% core growth, the 1.25x book-to-bill, the balance sheet, it all looks pretty solid. But the stock itself has been anything but smooth.
No, it has not.
It had a massive, 68% drawdown earlier this year. What happened there?
That suggests a period of just intense pressure, capitulation selling. The market, with high interest rates, it just punishes companies that are burning cash, even if they have a strong balance sheet.
So it got heavily washed out. But we've seen a sharp reversal lately.
We have a 45% snapback over the last month. It's a classic reversion from oversold structure. It suggests sentiment is finally starting to normalize.
Let's tackle the valuation debate, though, because a price-to-sales ratio of 6.9x, that looks expensive, especially when the sector average is closer to 2.9x. How do you square that?
That premium is because the market is pricing in future growth before the profits arrive. High-tech companies in these next-gen sectors always trade at a premium to the legacy players.
So you're paying for the potential of Starlab, not today's revenue.
Exactly. And what's more telling, I think, is the intrinsic value. A discounted cash flow analysis suggests a fair value of around $20.98.
So if the stock is trading below that, it implies there's still a discount to its fundamental long-term value.
It does. And speaking of confidence, that recent capital raise is another huge validation point.
The convertible notes offering?
Yeah, they upsized a $435 million offering. Getting that kind of money for a company that's currently posting losses, it signals that sophisticated institutional investors are underwriting the long-term plan.
It's a massive vote of confidence. So for the listener, what are the primary risks? What's the bear case here?
There are 2 main ones. First, the obvious one. They're not profitable. That $60+ million loss is real. The market will lose patience eventually.
And the second?
Execution risk. Big projects like Starlab are notorious for delays and cost overruns.
But that fortress balance sheet, does it make those risks manageable?
It does. That $413 million in cash is a huge buffer. If Starlab is delayed by 6 months, they don't have to scramble. And remember, that core defense business is still growing fast, which diversifies the risk.
So they have an insurance policy, basically. Okay, looking forward, what's the next key checkpoint for us to watch?
The immediate catalyst is the upcoming Q4 and full year 2025 earnings report. That's crucial.
We'll see if they hit the high end of their guidance.
Right. But more importantly, we'll get their initial outlook for 2026. That will tell us when the M&A synergies and the big Starlab revenue will really start to ramp up.
And zooming out, the macro environment seems almost custom-built for them.
It really is. Defense spending is structurally elevated. There's a huge geopolitical focus on space. Voyager's whole business is aligned with these national priorities.
So to wrap this all up, the core thesis here is one of compelling asymmetric optionality. Get the fast defense growth and the long-term Starlab play.
And it's all backed by that incredible balance sheet. Despite the losses and the volatility, it seems to be trading at a discount to its intrinsic value.
The key takeaway is that this is a multi-year hold, right? Maybe 2 to 4 years to see it play out.
Absolutely. You have to be patient to capture that full ramp-up. The setup appears asymmetric for the long-term holder. It really comes down to whether you think the risk of short-term losses is outweighed by the reward of owning a piece of future space infrastructure.